Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Understanding Business 2024. Bonus Chapter C. Narrated by Omar Mohsen Ibrahim Fouad. Bonus Chapter C. Managing Risk. Page 611. Learning Objectives. After you have read and studied this bonus chapter, you should be able to identify the environmental changes that have made risk management important, explain the 4 ways of managing risk, and distinguish between insurable and uninsurable risk. Define insurance policy, define insurance policy and explain the law of large numbers and the rule of indemnity. Discuss the various types of insurance businesses can buy to manage risk. Page 612. Getting to know Tricia Griffith, President and CEO of Progressive Insurance. When Tricia Griffith applied for a job as a claims adjuster trainee at Progressive more than 30 years ago, she did not plan to stay in the industry for long. "I really had no desire to work in insurance," said Griffith. "I went to school at Illinois State University, where State Farm is located, and I was like, ugh, who wants to be in insurance?" Instead, she intended to train as a claims rep for just a few years until she completed her MBA, Master's in Business Administration. But the more Griffith learned about insurance, the more she fell in love with it, leading her to dedicate her career to Progressive. After a few decades, she ascended to the position of CEO, making her one of the rare people in business to rise from entry-level employee to head of the company. Since becoming CEO, Griffith has guided Progressive's rapid growth in an industry that is not known for its innovation. Over a 3-year span, the company expanded from $20 billion in net premiums to $30 billion. In fact, Progressive has grown to become the nation's 3rd largest auto insurer, a remarkable jump for a company that was founded in 1937, specializing primarily in insuring high-risk drivers. Under Griffith's leadership, the company has moved far beyond Progressive's roots by opening new markets and applying innovative technology. In 2015, Progressive made a key decision to acquire home insurer ASI in an effort to convince consumers to bundle their auto and home insurance. In 2015, Progressive made a key decision to acquire home insurer ASI in an effort to convince consumers to bundle their auto and home insurance together. Progressive had seen little success in the home insurance market prior to the acquisition, so Griffith was chosen to lead the charge into the market. In just over 2 years, Progressive expanded its number of customers from 400,000 to 1 million. She also made the bold decision to bet on AI-powered technology. Under her direction, Progressive introduced a mobile app called Snapshot that employs artificial intelligence and machine learning to determine customers' premiums according to their driving behaviors. Progressive introduced a mobile app called Snapshot that employs artificial intelligence and machine learning to determine customers' premiums according to their driving behaviors. The company collects and analyzes billions of miles of driving data to measure distracted and risky driving based on specific variables. This information helps Progressive charge a higher rate for riskier drivers while retaining and rewarding safe drivers, although other insurers have adopted similar programs. Progressive has remained the leader in innovative technology according to investors and analysts. Today, the company has over 13 million policies in force and an estimated 500,000 employees. Griffith understands that leadership is not limited to a CEO's economic success. Coming up through the ranks at Progressive, she realized it's important to be accessible to staff and to create a culture that employees find both motivating and challenging. For example, the company's Innovation Garage serves as an employee think tank and experimental laboratory where employee ideas and suggestions are tested. Her workplace innovations and devotion to an inclusive culture have helped Progressive earn a spot on Fortune magazine's annual list of best places to work and Forbes' America's Best Large Employers. Accolades like this point to a bright future for Progressive, which Griffith is excited to tackle head on. I think we're going to be a bigger company. We're going to be well run, and we're going to have a culture where people want to work here, want to stay here, want to have careers, and where our customers want to stay because they get great service. In this bonus chapter, you will learn something about risk management. The industry is so large and there is so much to learn that we only scratch the surface. Nonetheless, risk management has become such a huge part of every manager's responsibilities that you need to know the basics of risk management before you become involved in any type of business. Sources: Wendy Conant, 10 Top Women CEOs, Investopedia, Investopedia.com, February 27th, 2023. Blake Morgan, How Progressive Stock Has Soared, under Tricia Griffith. Forbes, Forbes.com, November 15th, 2022. Progressive CEO Tricia Griffith wants leaders to engage in uncomfortable discussions. Fortune, Fortune.com, November 2nd, 2022. Nick Fortuna, Women in Finance. Tricia Griffith, Barron's, Barron's.com, March 24th, 2023. Spencer Hafron and Reddix. Page 613. Name that company. Insurance companies can operate as either stock insurance companies or mutual insurance companies. Stock insurance companies operate like any corporation that pay dividends and trades on the stock market. This company is one of the largest stock insurance companies in the United States. Name that company. Find the answer in the chapter. Understanding Business Risks, LOC-1. Identify the environmental changes that have made risk management important. No one knows better than Progressive CEO Tricia Griffith that managing risk is a challenge for businesses throughout the world. Almost every day we hear of a tornado, hurricane, earthquake, flood, fire, airplane crash, terrorist threat or attack, or car accident that destroyed property or injured or killed someone. The Insurance Institute for Business and Home Safety says that 1 out of 4 small businesses is forced to permanently close after a disaster. Hackers and viruses are an increasing threat to computers, and identity theft is commonplace. Theft and fraud can destroy small business. Business lawsuits in recent years have covered everything from job-related accidents to product liability. Such reports are so much a part of the news that we tend to accept these events as part of everyday life. But the losses of property, equipment, transportation, communications, security, energy, and other resources mean a great deal to the people and organizations injured by them. In some states, insurance against such loss is not available or is too expensive for high-risk businesses. New legislation in some areas aims to lessen some of these risks so that companies can obtain insurance coverage again at a reasonable price. A recent report found that over 30% of organizations have developed an enterprise risk management (ERM) program, and growing numbers are in the process of implementing one. An ERM program usually has a few well-defined goals, such as defining 1. Which risks the program will manage, 2. What risk management processes, technologies, and investments will be required, and 3. How risk management efforts will be coordinated across the firm. George Carstensen and DPA and Alamy stock photo. Edward Snowden, former technical assistant for the CIA, leaked classified documents to the media regarding the NSA's tactics in tracking U.S. citizens, international governments, and companies. What strategies can help firms and even governments protect themselves against this type of pure risk? How rapid change affects risk management. Risk goes beyond the obvious dangers of fire, theft, or accident. It is inherent in every decision a manager makes, and the prudent company assesses its exposure in all of them. Risk managers are expanding their expertise into human resources, information technology, security, legal, site construction, and more. Change is occurring so fast that it is difficult to identify new risks until they are upon us. Who can evaluate the risks of buying or selling products online, or the risk of a cyber attack by hackers? How will currencies fluctuate in the next financial crisis? And how will their daily ups and downs affect the profits of global trade? How will climate change affect farms, cattle, and the price of food? What would happen to the economy if there were a new terrorist attack? Think of how the economy was rocked by the COVID-19 pandemic and the war in Ukraine. What can we do to manage the risks of social unrest at home and abroad? Let's explore how companies go about managing risk. We'll begin by going over a few key terms. Page 614, Managing Risk. LOC-2, explain the 4 ways of managing risk and distinguish between insurable and uninsurable risk. Risk is the chance of loss, the degree of probability of loss, and the amount of possible loss. There are 2 different kinds of risk. Speculative risk can result in either profit or loss. A firm takes on speculative risk by buying new machinery, acquiring more inventory or a new plant, and making other potentially profitable decisions in which the profit. A firm takes on speculative risk by buying new machinery, acquiring more inventory, or a new plant, and making other potentially profitable decisions in which the probability of loss may be relatively low and the amount of loss known. An entrepreneur's chance to make a profit is a speculative risk. Banks that bought mortgage-backed securities in 2008 were taking a speculative risk. Pure risk is the threat of loss with no chance for profit, such as the threat of fire, accident, or theft. If such events occur, a company loses money, but if they don't, the company gains nothing. The risk that most concerns business people is pure risk. It threatens the very existence of some firms. Once they identify pure risks, firms have several options. 1. Reduce the risk. 2. Avoid the risk. 3. Self-insure against the risk. 4. Buy insurance against the risk. We'll discuss the option of buying insurance in detail later in this chapter. First, we'll discuss each of the other alternatives for managing risk, which reduce the need for outside insurance. Reducing risk. A firm can reduce risk by establishing loss prevention programs such as fire drills, health education, safety inspections, equipment maintenance, accident prevention, and so on. Many retail stores use mirrors, video cameras, and other devices to prevent shoplifting. Water sprinklers and smoke detectors help minimize fire loss. Most industrial machines have safety devices to protect workers' fingers, eyes, and so on. Employees as well as managers can reduce risk. Truck drivers can wear seat belts to minimize injuries from accidents. Operators of loud machinery can wear earplugs to reduce the chance of hearing loss. And those who lift heavy objects can wear back braces. Many companies have instituted wellness programs to keep employees healthy, active, and alert on the job. The beginning of an effective risk management strategy is a good loss prevention program. However, high insurance rates have forced some firms to go beyond merely preventing risks to avoiding them. In extreme cases, by going out of business, avoiding accidents is critical to the survival of the firm and its workers. Avoiding risk. We can't avoid every risk. There is always the chance of fire, theft, accident, or injury, but some companies are avoiding risk by not accepting hazardous jobs and by outsourcing shipping and other functions. The threat of lawsuits has driven some drug companies to stop manufacturing new drugs, and some consulting engineers refuse to work on hazardous sites. Some companies cannot attract members for their board of directors due to potentially liability. Some companies cannot attract members for their board of directors due to potential liability concerns that could develop from legal action against the firms they represent. Many companies have cut back on their investments to avoid the risk of financial losses. Page 615. Self-insuring. Self-insurance is the practice of setting aside money to cover routine claims and buying only catastrophe insurance policies to cover big losses. It is most appropriate when a firm has several widely distributed facilities. Firms with a single huge facility, such as an Amazon warehouse facility, in which a major fire or earthquake could destroy the entire operation, usually turn to insurance companies to cover the risk of loss. One of the riskier self-insurance strategies is for a company. One of the riskier self-insurance strategies is for a company to go bare, paying claims from its operating budget instead of from a special fund. The whole firm could go bankrupt over one claim if the damages are high enough. A less risky alternative is to form group insurance pools that share similar risks. Buying insurance to cover risk. Although well-designed and enforced risk prevention programs reduce the probability of claims, accidents do happen. Although well-designed and enforced risk prevention programs reduce the probability of claims, accidents do happen. Insurance is the armor individuals, business, and nonprofit organizations use to protect themselves from various financial risks. Together, they spend about 10% of gross domestic product, GDP, on insurance premiums. The federal government provides some insurance protection, see Figure C.1, but individuals and businesses must cover most on their own. Figure C.1, public insurance, state or federal government agencies that provide insurance protection. Unemployment compensation provides financial benefits, job counseling, and placement services for unemployed workers. Social Security provides retirement benefits, life insurance, health insurance, and disability income insurance. Federal Housing Administration, FHA, provides mortgage insurance to lenders to protect against default by home buyers. National Flood Insurance Association provides compensation for damage caused by flooding and mudslides to properties located in flood-prone areas. Federal Crime Insurance provides insurance to property owners in high-crime areas. Federal Crop Insurance provides compensation for damaged crops. Pension Benefit Guaranty Corporation insures pension plans to prevent loss to employees if the company declares bankruptcy or goes out of business. To reduce the cost of insurance, some companies buy a business ownership policy, BOP, a package that includes property and liability insurance. Let's continue our discussion of insurance by identifying the types of risks that are uninsurable and insurable. Shmuel Thaler and Media News Group and Santa Cruz Sentinel and Getty Images. Businesses cannot accurately estimate damage from natural disasters like hurricanes before they occur. That's the reason for having insurance. Do you think most American businesses have insurance coverage for hurricane damage? Why or why not? Page 616. What risks are uninsurable? Not all risks are insurable. An uninsurable risk is one that no insurance company will cover. Examples of things that you cannot insure include market risks, like, for example, losses that occur because of price changes, style changes, or new products that make your product obsolete. Political risks, like, for example, losses from war or government restrictions on trade. Some personal risks, such as loss of a job, and some risks of operation, like, for example, strikes or inefficient machinery. What risks are insurable? An insurable risk is one the typical insurance company will cover using the following guidelines. 1. The policyholder must have an insurable interest, which means the policyholder is the one at risk to suffer a loss. For example, you cannot buy fire insurance on your neighbor's house and collect it. The policyholder must have an insurable interest, which means the policyholder is the one at risk to suffer a loss. For example, you cannot buy fire insurance on your neighbor's house and collect if it burns down. 2. The loss must be measurable. 3. The chance of loss must be measurable. 4. The loss must be accidental. 5. The insurance company's risk should be dispersed, that is, spread among different geographic areas, so a flood, tornado, hurricane, or other natural disaster in one area will not bankrupt the insurance company. 6. The insurance company must be able to set standards for accepting the risk. Page 617. Test prep. Why are companies more aware now of the need to manage risk? What is the difference between pure risk and speculative risk? What is the difference between pure risk and speculative risk? What are the 4 major options for handling risk? What are some examples of an uninsurable risk? Understanding insurance policies, LOC-3, define insurance policy and explain the law of large numbers and the rule of indemnity. An insurance policy is a written contract between the insured, whether an individual or organization, and an insurance company that promises to pay for all or part of a loss by the insured. A premium is the fee the insurance company charges, the cost of the policy, to the insured. A claim is a statement of loss that the insured sends to the insurance company to request payment. Like all private businesses, insurance companies are designed to make a profit. They therefore gather data to determine the extent of various risks. What makes it possible for insurance companies to accept risk and profit is the law of large numbers. The law of large numbers says that if a large number of people or organizations are exposed to the same risk, a predictable number of losses will occur during a given period of time. For your information, the figures for homes are as follows. Over the course of a 30-year mortgage, a home has a 9% chance of catching fire and a 26% chance of flooding. Once the insurance company predicts the number of losses likely to occur, it can determine the appropriate premiums for each policy it issues against that loss. The premium will be high enough to cover expected losses and yet earn a profit for the firm and its stockholders or policyholders. Today, many insurance companies are charging businesses high premiums, not for expected losses, but for the costs they anticipate from the increasing numbers of lawsuits, court cases, and high damage awards. Yellow Dog Productions and Getty Images. Almost everyone who drives is exposed to the risk of having an insurance. Almost everyone who drives is exposed to the risk of having an accident at some point. Insurance companies use the law of large numbers to predict the losses such accidents will cause and set their policy premiums high enough to. Insurance companies use the law of large numbers to predict the losses such accidents will cause and set their policy premiums high enough to cover the losses while earning a profit. How much do you pay for your auto policy? Page 618. Rule of indemnity. The rule of indemnity says an insured person or organization cannot collect more than the actual loss from uninsurable risk, nor can you buy two insurance policies, even from two insurance companies, and collect from both for the same loss. You cannot gain from risk management. You can only minimize losses. Types of insurance companies. There are two major types of insurance companies. A stock insurance company is owned by stockholders, just like any other investor-owned company. A mutual insurance company is an organization owned by its policyholders. It is a nonprofit organization, and any excess funds over losses, expenses, and growth costs go to the policyholders in the form of dividends or premium reductions. Prudential is one of the largest stock insurance companies in the United States, whereas New York Life is one of the largest U.S. mutual insurance companies. Test prep. What is the law of large numbers? What is the rule of indemnity? Insurance coverage for various kinds of risk. LOC-4. Discuss the various types of insurance businesses can buy to manage risks. There are many types of insurance to cover various losses: property and liability insurance, health insurance, and life insurance. Property losses result from fires, accidents, theft, or other perils. Liability losses result from property damage or injuries suffered by others for which the policyholder is held responsible. Figure C.2 lists the types of insurance available. Let's begin our exploration of insurance by looking at health insurance. Figure C.2, private insurance, property and liability, fire, covers losses to buildings and their contents from fire. Automobile covers property damage, bodily injury, collision, fire, theft, vandalism, and other related vehicle losses. Homeowners covers the home, other structures on the premises. It covers the home, other structures on the premises, home contents, expenses if forced from the home because of an insured peril. Covers the home, other structures on the premises, home contents, expenses if forced from the home because of an insured peril. Third-party liability and medical payments to others. Computer coverage covers loss of equipment from fire, theft, and sometimes spills, power surges, and accidents. Professional liability protects from suits stemming from mistakes made or bad advice given in a professional context. Business interruption provides compensation for loss due to fire, theft, or similar disasters that close a business. Covers lost income, continuing expenses, and utility expenses. Non-performance loss protection protects from failure of a contractor, supplier, or other person to fulfill an obligation. Criminal loss protection protects from loss due to theft, burglary, or robbery. Commercial credit insurance protects manufacturers and wholesalers from credit losses due to insolvency or default. Public liability insurance provides protection for businesses and individuals against losses resulting from personal injuries or damage to the property of others for which the insured is responsible. Extended product liability insurance covers potentially toxic substances and products, environmental liability, and corporations, director and officer liability. Fidelity bond protects employers from employee dishonesty. Surety bond covers losses resulting from a second party's failure to fulfill a contract. Title insurance protects buyers from losses resulting from a defect in title to property. Cyber attack insurance helps protect companies from hackers. Health insurance, basic health insurance covers losses due to sickness or accidents. Major medical insurance protects against catastrophe. Major medical insurance protects against catastrophic losses by covering expenses beyond the limits of basic policies. Hospital insurance pays for most hospital expenses. Surgical and medical insurance pays costs of surgery and doctor's care while recuperating in a hospital. Dental insurance pays a percentage of dental expenses. Disability income insurance pays income while the insured is disabled as a result of accident or illness. Vision insurance pays for eye exams, glasses, contacts, and sometimes vision correction surgery. Life insurance, group life insurance, covers all the employees of a firm or members of a group. Owner or key executive insurance enables businesses of sole proprietors or partnerships to pay bills and continue operating, saving jobs for the employees, enables corporations to hire and train or relocate another manager with no loss to the firm. Retirement and pension plans provides employees with supplemental retirement and pension plans. Credit life insurance pays the amount due on a loan if the debtor dies. Health insurance. The United States went through a period of major changes in health insurance with the implementation of the Patient Protection and Affordable Care Act, PPACA, also referred to as Obamacare. This legislation caused the government to be much more involved in the health insurance process. The law has been criticized and praised, and its merits and failings have been debated since its passage. Because health insurance is so important to your future, Because health insurance is so important to your future, you should keep up with any changes that might occur with the ACA. We are likely to see many variations of health coverage in the future. Page 619, page 620. Health savings accounts. Health savings accounts, HSAs, formerly called medical savings accounts, are tax-deferred savings accounts linked to low-cost, high-deductible health insurance policies. The idea is for your employer or you to take the money currently spent on high-cost, low-deductible health insurance and deposit it into a health savings account. You would use the money only for needed health care services. At the end of the year, you get to keep your money you don't spend in the account for future medical coverage. One major benefit to you is that the money grows tax-free until you take it out. Disability insurance. Disability insurance replaces part of your income, usually 50 to 70%. If you become disabled and unable to work, you must usually be disabled for a certain period, such as 60 days, before you can begin collecting. Insurance experts recommend getting disability insurance if your employer does not offer it, because the chances of becoming disabled by a disease or accident when you are young are much higher than the chance of dying. The premiums for disability insurance vary according to age, occupation, and income. Workers' compensation. Workers' compensation insurance guarantees payment of wages, medical care, and rehabilitation services such as retraining for employees injured on the job. Employers in every state are required to provide this insurance. It also pays benefits to the survivors of those who die as a result of work-related injuries. The cost of workers' compensation varies by the company's safety record, the size of its payroll, and the types of hazards its workers face. For example, it costs more to insure a steel worker or iron worker than an accountant because the risk of injury is greater. Liability insurance. Professional liability insurance covers people found liable for professional negligence. If a lawyer gives advice carelessly and the client loses money, the client may sue the lawyer for an equal amount. If a lawyer gives advice carelessly and the client loses money, the client may sue the lawyer for an amount equal to that loss, and liability insurance will cover the lawyer's loss. Professional liability insurance is also known as malpractice insurance. That term may bring doctors and dentists to mind, but many other professionals, including mortgage brokers and real estate appraisers, buy professional liability insurance because of large lawsuits their colleagues have faced. Pachyrpon, Sakaluche, and Moment and Getty Images. An employee with a work-related illness or injury can get workers' compensation benefits regardless of who was at fault. In exchange for these benefits, employees usually do not have the right to sue the employer for damages related to those injuries. Page 621. Product liability insurance covers liability arising out of products sold. See bonus chapter A. A person injured by, say, a ladder, some other household good, or pharmaceutical product may sue the manufacturer for damages. Life insurance for businesses. Regardless of how careful we are, we all face the prospect of death. to ensure that those left behind will be able to continue the business. Entrepreneurs often buy life insurance that will pay partners and others what they need to keep the firm going. The best kind of insurance to cover executives in the firm is term insurance, but dozens of new policies with interesting features are now available. Insurance coverage for home-based businesses. Homeowners' policies usually don't have adequate protection for a home-based business. For example, they may have a limit for business equipment. For more coverage, you may need to add an endorsement, sometimes called a rider, to your homeowner's policy. If clients visit your office, or if you receive deliveries regularly, you may need home office insurance. It protects you from slip and fall lawsuits and other risks associated with visitors. For more elaborate businesses, such as custom cabinetry shops and other types of manufacturing or inventory keeping businesses, you may need a business owner policy. Unless you are an expert on insurance, you will need to consult an insurance agent about the best insurance for your home-based business needs. The risk of damaging the environment. Risk management now goes far beyond the protection of individuals, businesses, and nonprofit organizations from known risks. It means the evaluation of worldwide risks with many unknowns such as climate change. It also means prioritizing these risks so that international funds can be spent where they can do the most good. No insurance company can protect humanity from all such risks. These risks are the concern of businesses and governments throughout the world, with the assistance of the international scientific community. They should also be your concern as you study risk management in all its dimensions. For example, think of the risks that accompany the search for natural gas using fracking or searching for oil in deep water exploration. Now that such a search has gone global, companies throughout the world are examining the risks involved. That means more jobs and more interest in risk management in general. Protection from cyber attacks. Often you will see articles in newspapers about a company being hacked by some outside or inside individuals or groups that steal your private information such as social security numbers, addresses, and so on. Cyber risk insurance can help a business prepare for the worst. For example, it will cover a company should its employees or customers decide to file a lawsuit against it in the event that their information is leaked. Test prep. Why should someone buy disability insurance? How many different kinds of private insurance can you name? Page 622, Summary. LOC-1, identify the environmental changes that have made risk management important. What changes have made risk management more important? Hurricanes, floods, terrorist threats, and attacks, identity theft, and an unstable economy have all contributed to additional risk and the need for more risk management. LOC-2, explain the 4 ways of managing risk and distinguish between insurable and uninsurable risk. What are the 4 major ways of managing risk? The major ways of managing risk are 1. Reduce risk, 2. Avoid risk, 3. Self-insure, and 4. Buy insurance. What's the difference between insurable and uninsurable risk? An insurable risk is the one the typical insurance company will cover. Generally, insurance companies use the following guidelines when evaluating whether a risk is insurable. 1. The policyholder must have an insurable interest. 2. The amount of loss should be measurable. 3. The chance of loss should be measurable. 4. The loss should be accidental. 5, the risk should be dispersed. And 6, the insurance company can set standards for accepting risks. Uninsurable risk is risk that no insurance company will cover. Examples of things that you cannot insure include market risks, political risks, some personal risks, such as loss of a job, and some risks of operation, like, for example, strikes or inefficient machinery. LOC-3, define insurance policy and explain the law of large numbers and the rule of indemnity. What is the rule of indemnity? The rule of indemnity says an insured person or organization cannot collect more than the actual loss from an uninsurable risk. The rule of indemnity says an insured person or organization cannot collect more than the actual loss from an insurable risk. LOC-4 discuss the various types of insurance businesses can buy to manage risks. Page 623. What are the two kinds of insurance companies? A stock insurance company is owned by stockholders, just like any other investor-owned company. A mutual insurance company is owned by its policyholders. What kind of policies cover health risks? Healthcare and health insurance are topics that are heavily debated today. The government's role in healthcare and the role of private insurance will likely see changes going forward after much discussion and compromise. Health savings accounts, HSAs, enable you to pay for your health needs from a tax-deferred savings account and buy insurance for catastrophes. What is workers' compensation insurance? Workers' compensation insurance guarantees payment of wages, medical care, and rehabilitation services like retraining for employees injured on the job. Employers in every state are required to provide this insurance. Professional liability insurance covers people found liable for professional negligence. Product liability insurance provides coverage against liability arising out of products sold. Most businesses also have some kind of life insurance for their key executives. Serving as a director on a corporate board carries with it great standing and potential risk of liability. If you conduct business from home, you should also have some form of home office insurance to cover liabilities. What are businesses doing to cover risks of harming the environment? Many businesses are doing what they can to minimize damage to the environment. Such risks, however, are often beyond what businesses can manage. They are also the concern of governments around the world. Why do companies carry cyber risk insurance? Companies carry cyber risk insurance to protect against lawsuits that could be filed against them due to cyber attacks where personal information of employees, customers, and so on is compromised. Key terms: claim, health savings accounts, HSAs, insurable interest, insurable risk, insurance policy, law of large numbers, mutual insurance company, premium, pure risk, rule of indemnity, self-insurance, speculative risk, stock insurance company, uninsurable risk. Critical thinking. 1. Are you self-insuring your residence and assets? What have you done to reduce your risk? Have you done anything to avoid risk? How much would it cost to buy insurance for your dwelling and the contents? 2. What risks do you take that insurance cannot cover? 3. What actions have you taken to avoid risk? 4. What can you do to lower your personal risk of loss from natural disasters such as floods, hurricanes, and tornadoes? Putting principles to work. Purpose: to to learn about insurance for your dwelling and property and to examine the issue of liability. Exercise. Go to the Insurance Information Institute's website, iii.org. Explore the site and then answer the following questions. 1. What is the homeowner's insurance? 2. What is covered by a standard homeowner's policy? 3. What is renter's insurance? Page 624, Developing Career Skills. Key, Team Analytic Communication Technology. 1. List the ways you could reduce risk in your life, such as not driving above the speed limit. Form small groups and share what you and others have written. Which of your classmates' suggestions can you adopt in your life? 2. You cannot insure yourself against speculative risk. However, you can minimize the risks you take when investing. Compare and contrast the risks of investing in stocks versus investing in bonds for the long term. Refer to bonus chapter D for help. 3. Much of risk management consists of reducing risky behavior. What kinds of risky behavior have you observed among fellow college students? How can college students learn about and minimize these risks? Are they doing so? Discuss the merits of having a risk manager for education facilities. 4. Form small groups and discuss liability insurance, automobile insurance, health insurance, renter's insurance, life insurance, and disability insurance. Develop a list of questions to discuss openly in class so that everyone can contribute their thoughts about these issues. Do your fellow students understand all of these types of insurance? 5. Discuss with a group in your class the risks of a terrorist attack, a natural disaster, climate change, or another major health disaster. Which risk do you perceive as most likely? Most dangerous? Discuss what could you do to warn others of such risks and motivate them to do something about them. Career exploration. If you are interested in pursuing a career in risk management, here are a few to consider. Find out about the tasks performed, skills needed, pay, and opportunity outlook in these fields in the Occupational Outlook Handbook, OOH@BLS.gov. Insurance underwriter decides whether to provide insurance and determines coverage amounts and premiums. Emergency management director prepares plans and procedures for responding to natural disasters or other emergencies. Insurance sales agent contacts potential customers and sells one or more types of insurance. Notes. Bonus Chapter D, Managing Personal Finances and Investing, page 625.